Volatility is a reality in the stock market. Warren Buffett talks a great deal about it. He just says volatility, get used to it. Well, there's volatility to respect, and then there's volatility to ignore. Now, let's look at the S&P 500 here over the last, say, 20 years. This area here was the top of the dot-com bubble, and there was a tremendous amount of volatility. And this would have been volatility to respect. The market dropped about 50% on that move. Then we stabilized, and then we got volatility to respect to the upside. And I'm going to show you a little bit more about this with a little bit of a snapshot. But this would be, volatility to ignore because you were in a strong uptrend. Again, we get to 07, market drops over 60%. Now realize, in 1929, the Great Depression, the stock market dropped 84%. This was about a 64% drop, approximately. So the point is that we have gone through a drop in the market very similar to what we saw in 1929. Now, did we recover from 29? Absolutely. It was probably a really good time to be buying stocks. In fact, Sir Jonathan Galbraith, the old economist, said that he was investing at that time, and what was the most important thing that he learned? He said, cut your losses short and let your winners run. That was the most important thing that he picked up on. So let's look at a snapshot of this area first. Okay, now, what I've done here is I've taken all the price out. There's no price here. This is nothing more than two moving averages of the S&P 500 starting in the year 2000 and going into the bear market. Now, when the 200-day moving average, that's what the red line represents, the 200-day moving average. The blue line represents the 50-day moving average. Now, the 50-day moving average crossed below the 200-day moving average. The 200-day moving average was in a downtrend, so this would have been volatility to respect, because that's this point. The point I'm going to show you is here, which is here. Okay, now let's go to 2007. Again, everything's looking fine, everything's hunky-dory. Then the 50-day crosses below the 200-day, and the 200-day goes into a downtrend. Okay, bear market. So unfortunately, the market dropped dramatically, but this was volatility to respect. Now, how do we look today? Let's just kind of bring this all current and get away from history. 2015, we're cruising along, things are looking very nicely, then boom, various reasons, slowdown in China, etc. The 50-day moving average crosses below the 200-day. The 200-day is in a downtrend. This is volatility to respect. So we went to a very heavy cash position because we don't know. We don't know if this is going to turn into an 07 or a 2000. But then we came back and we retested the 200-day, but the important thing to note was the 200-day never turned up. So you would have continued to respect this volatility. Then we came down and really bad things happened in the first quarter of 16. Now, we're getting a recovery, so if you really think about it, this look, with this white space especially, doesn't look anything like this look here, which is, across and the 200-day moving down. We currently have a cross above the 200-day, and the 200-day is moving up. So being that trend following is all about taking what's happening now, because you really cannot predict the future. Nobody can predict the future. Looking at the past is kind of a good idea just to get a feel for things, and that's what we're doing. But I am saying in the other two periods of time, and I'm just using as an illustration. Now let's take this into some other areas here. Let's go into gold. Now, 200-day downtrend, came on down. The consensus thinking is that, we'll never have inflation again. Bonds are kind of a tough area during inflation. In fact, I can remember back in the 70s that I watched bond portfolios drop dramatically between 1976 and 1982. It was not a fun period to be in the bond market. But lately, because of all the fear, bonds have been kind of the place to be. So all of a sudden here with gold, in the early part of this year, we got a cross above the 200-day, and the 200-day is moving up. Now, we are seeing some short-term weakness here, but this is somewhat saying that maybe inflation is coming back because gold is a barometer for inflation. Now, I did want to mention China real quick. The reason for that is they just came out with their GDP numbers this week. Their economy is growing at 7%. And they're upset about it because they want to grow at 10%. But the point is, our economy is growing at less than 2%. So you cannot ignore this. Now, you can see here that over the last 10 years, the Chinese market is pretty much just, it came down, it cracked, moved side. It's been basically moving sideways now for 10 years. Now, this is a growthy situation. This is where, people that are looking for growth would go to China. Now, with a 7% GDP growth rate, I just don't think you can ignore it. Now, I also want to look at a bond fund. This is the 20-year U.S. Treasury bond fund. You can see, again, that there really is no sign here that, bond prices are any kind of long-term downtrend or anything. In fact, they're in an uptrend. But we're starting to see some short-term weakness that I think should be observed. Now, on the energy patch, we're seeing energy stocks, same type of scenario, starting to see improvement. The financial stocks, this has been another problem area. Again, you can see the dramatic shift here, and as the white space here is dramatic, and that means that the 50-day is moving much more rapid than the 200-day. But what's important is that 200 days in an uptrend. Now, here's technology stocks. I think this is an important group for us. Again, growth-oriented stocks. Again, very healthy pattern here, no problem whatsoever. Here's electric utilities. Now, I've been kind of hammering on utilities because of the dividend situation. Again, this has been a really hot area for the last 10 years. This has been where you wanted to be, but it's an interest rate driven investment. It's going up, not because their earnings are growing. That has nothing to do with it. It all has to do with the fact that they're paying out a tremendous amount, percentage-wise, a tremendous amount of their earnings to pay a dividend. Well, the dividend reduces book value. So, it actually reduces shareholder equity. But we're starting to see some weakness here, and, we may get a death cross in the utilities. So that would be something to observe. So basically, in conclusion, we're recovering from the worst drop in the stock market since 1929. This has been the slowest economic recovery in history. This quarter, earnings will be out, and we're hoping for a good result. And if we do get a good result this quarter, this will be the first up quarter for earnings in 5 quarters. Let's hope for that. If you have any questions, give me a call.